Rob, did you have one more question? Or
Well,
it's
I just wanted to throw out a figure to you for the second tier, 12.25% maybe for our second tier employees.
Well, so
In the public safety realm and the non-public safety realm, the second tier would be 6.25%.
I'm sorry.
These are the figures that I were given by our fiscal unit.
I'm sorry, I thought you were asking about the actual benefit formula percentage, but I think you're asking something else. I'm not sure what, is that what rate, what percentages are those? What do they represent?
Well, you had said that we're at 30% here at the district,
Okay.
and I was given 27.877%.
Okay.
And for the second tier public safety, I was given, for the second tier, I was given 12.25% for safety. Non-public safety, I was given 15.685%. Excuse me, 15.685%. And for the second tier, I was given 6.25%.
Yeah.
Which we don't have an employee in that tier, according to the calculation. Oh, excuse me, we have one?
No, those numbers are from fiscal year 13-14.
Right.
So now we're in 14-15.
That's right.
You have more
Yeah.
numbers.
The 20.
So we're,
I think, I'm going to, because I think it's too hard without having these in front of us to review the numbers. But clearly we're dealing with different years and different things. It's probably, we ought to continue this conversation when we have the hard numbers in front of us and we can actually refer to them.
well, we're also talking about the second tier, which is what we've instituted here as a fire district, which is saving almost half of those yearly benefits. So we're in some way trying to do so. I know the long run isn't really great either, but we're doing something according to what we have available to us and what we can do now with the limitations. The way Ned spoke about also is that they pretty much boxed us in on a lot of this stuff, and we're doing the best we can relative to creating those second tiers and trying to work with CalPERS.
Yeah, the one thing I'd say is that your pension reform hit in 2013, right? So people that were here before then have the 350 formula. Then the people after that is their second tier, that's the 2.7 to 57 formula, right? That's actually under the pension reform, there actually were 3 safety formulas that were possible, and that's actually the highest of the 3. So there are lower options for that second tier.
I'm just speaking about what we instituted as a district.
Okay.
Yeah, thank you.
And I have, before I go to the public, I just have one quick question, just to make sure, if it's not true, then that's fine. We have this unfunded liability with CalPERS. Am I correct that in their internal counting, they're charging us 7.5% interest on that unfunded liability?
Yeah, they're assuming you're gonna get 7.5%
Today.
long term.
Today.
And so they're adding that to our bill, the internal bill.
So that was certainly true on the side fund that you paid off, and that's why that was smart to pay that off, was because that was a debt where they charged you 7.5% regardless of what happened. Whether they earned 13% or 0, they charged you 7.5 each year. So that was effectively a credit card debt, and that's why it's very good to pay that off. On the ongoing plan, now that that's gone, they're assuming you're gonna earn 7.5%. So you could look at it as they're charging you that, but you're gonna get charged more or less depending on how
They're not charging us that.
But I wasn't clear if they were doing internal accounting.
What they're doing is they're giving us the current contribution rate is based on their assumption that they're actually going to make, I think it's now 7.25.
They're still 7.5.
Or it's still 7.5? So it's based on the assumption that 7.5, but it's a conditional bill. Here's your bill, assuming we get 7.5%. And oh, by the way, if we don't get 7.5%, your bill's going to be greater. So that's where the seduction takes place.
Okay.
You go out and buy a car, and they say it's $12,000, but later on they come back and say, well, really the car is going to cost you more than $12,000.
Okay. Okay,
The
thank you.
drive out costs.
I'm gonna then ask if,
Can I ask?
oh,
So
sorry.
Doug, just, so I think that the side fund rate was like 7.75% at the time,
Right,
right?
the time you paid it off.
Right, and so now it's at 7.5, and actually, last year when Rex and I attended a CSDA meeting regarding this whole pension issue, we asked if there's even any political will on their part, because the CalPERS board is not necessarily amenable to decreasing that. But what do you think the chances are to decrease it even 0.25%?
Well, about a year ago, I think the whisper number was that they would like to go to 7.25, and there was a lot of talk of that. They did their due diligence, reviewed it, and decided to keep it at 7.5.
7.5,
And
yeah, that's
so,
what they,
yeah,
so no changes in the foreseeable future.
right.
Okay.
And if I remember right, it was, you know, rather than maybe setting an investment policy
Yeah.
and then determining what that resulted in terms of long-term return, I think at one point the board kind of said, well, we don't want to change that 7.5. So we only want to look at investment options that are going to keep us there. And so they remained at the 7.5.
Good, thank you.
Okay, so I'd like to ask if anybody in the audience would like to address. Please, Mickey, will you stand up? I think, let me ask just, how many people from the audience, other people would like to address also? Just want to be mindful of the time. And are you able to keep comments to say 3 minutes or something? Is that?
Oh, certainly.
Okay,
So
thank
I
you.
have a question. So statement first, though. Part of
Mickey, I'm sorry, will you
the,
introduce yourself just for the sake of
yes,
the
I'm
tape?
Mickey Winkler, and I live in Menlo Park. Our CalPERS bill is based on the salaries that our firefighters receive. So that's a statement. And the question is, it seems to me that unlike the situation with police and Chuck Reed in San Jose, there are an oversupply of firefighters. I think at one point there were 50 or 100 or even more qualified applicants for every open firefighter job. And I would like to ask the chief or someone whether that situation is still true.
Chief?
I think it varies based upon the hiring and who else is hiring. I think it's what you're saying isn't necessarily untrue. If you look at the last several years where many agencies have laid off personnel, there's a surplus of people that went to college and took their classes and there weren't enough job openings. I think there's a lot of agencies now that are poised to hire because they've kind of exhausted employees that stayed longer or wanted to leave but didn't leave. To qualify, that's a tough one because you may get applicants, but it doesn't mean that they're all qualified nor that they're the best. And I think that's the part where we see a lot of applicants, but how many of those will actually get through the process, the background screening, different things that would disqualify them. That number over the years has increased, unfortunately. So that's the part where, I don't disagree with you. There's a lot of applicants. The part that to qualify, that's where it gets a little bit more difficult to accurately answer your question.
Thank you, Chief. And of course, I was just referring to firefighters, not to the support staff.
Exactly.
And I have the deepest respect and admiration for our firefighters. Thank you.
Anybody else from the public who would like to ask a question or address the board? Okay, thank you. Then I think why don't we just have discussion among ourselves or any comments that you'd like to make? Actually, I promised Rob that I would allow, not allow, but ask Matt the question that you'd asked earlier, if Matt had any information on that.
Yeah, and I don't think that I do. I think that we can continue that conversation as we move forward. But I think in terms of the potential liabilities associated with hypothetical lawsuits against CalPERS or the bankruptcies, it's just a very difficult question to answer right now that would require a significant amount of it's not a question we'd want to answer later. I'll put it that way.
Great, no, thank you.
Chief?
Yeah, so the only other thing, and I think since we have the actuarial in the room, so the district, what was relayed earlier is by Director Corrali and the questioning, is we are saving at 41%, which is well above what the rate is currently that's being charged, in line with what the future may hold at 2020. We did pay off the side fund at 350, which was $12.5 million. That was not an easy decision for the board at the time because it would reduce the cash position of the district in the midst of an economic downturn. So, I don't want to make it sound as if for the board members that were there, because they know that was not an easy thing to do. The interest rate surely, was one of the reasons that made sense because it was not at 7 3/4, but in the years where it was above 7 3/4, you can make more money elsewhere. The district did do that. So it was self-evident, but it wasn't an easy decision because it would have other effects. The other thing that we've discussed, since we're saving at the 41% ratio, and we would also, when we have vacancies, put additional funding in that account in the reserve, as well as the board made decisions to put other monies that came in, other revenues that are realized in the reserve. We're over $10 million. So with the unfunded liability at 41, one of the options that we've discussed recently, which is for consideration of the board at least tonight, obviously it's a study session, is there a benefit to pay PERS? Will they even take a payment of $10 million or maybe more, because we're slightly over that now with the reserve? Is that the smart way to go, or is it to leave it in a fund that we control, where we know where the money is, obviously not making as much in interest, but certainly would it pay down the prime rate, and then what would that drop to? And that, we haven't asked those questions to the actuarial yet, simply because we really haven't. We've been batting it around with staff, whether that made more sense to offer that up to the board as an option.
Why don't we hear from that, actually?
Yeah, to come in a little on that first, and something I hadn't mentioned is that your plan is in a pool with other agencies,
Right,
just
the risk.
350, right? Right, it's a risk pool, and traditionally, if you had extra money and went to CalPERS, there would be no reason to pay it because the money would go into the pool, and you take your 10 million, then it wouldn't reduce your future contributions by 10 million, it'd go out to everybody else in the pool, and nobody would do that.
But that's changing.
That's right, that's changed now. So they have set something up, I'm not sure exact timing, but to start taking additional contributions if you want to. It's similar to the side fund, but you're gonna get actual investment earnings credited. So it's not as though if you take 10 million, they're gonna guarantee the 7.5. If they lose a bunch of money, you're gonna lose a bunch of money on the 10 million. If they do much better than 7.5, it's gonna help you out. So
The key issue there is, we just would have to make the decision, are we a better investment manager than CalPERS?
Correct.
Right.
And I think, that to me is a real simple decision. There's no doubt that they're a better investment manager than we are, because we're not in that business. But, that's where the decision would come. Can we manage it better than they can manage it?
And it's certainly a long-term decision. If you look at recent years, I don't know what you folks are earning on your money, but there's no way it's near 7.5%. I mean, that's 0.5% maybe or something.
We're in late, very conservative,
Okay.
which is a good place to be.
So, yeah, right.
We're not leaving, bro.
Yeah, good.
Exactly.
So, yeah, I mean, long-term, expectation is you would earn quite a bit more, but that's all very new. We really, we're kind of holding off for agencies that have money and thinking of doing this, and it's been, questions about this have been generated by the new accounting statement, right? Because it's going to reduce that unfunded that goes on the balance sheet. We've been holding off on recommending agencies do it only because we'd like to see, we don't have all the details of how CalPERS is going to administer this. And so we'd just like to have a little more information before we can, say, yeah, this makes a lot of sense. But we anticipate it probably would, make sense to pay that down, recognizing, you're going to be in, you're going to have the money invested with the rest of the funds.
Peter?
Yeah, we're running out of time, so I'm not going to make a long speech, but I would like to take the opportunity to thank Linda and Gregory and the firefighters who are here tonight. I think it's real important for us to all appreciate that we're in this boat together. And the responsibilities I see to the board is to not only look after the best interest of the citizens and the taxpayers, but also to take care of our employees. And Linda, I already mentioned to you privately how much I appreciated the letter that you presented to us this evening. And I hope that moving forward, that the board and the management team and the employees can constructively look together and say, what can we do that's best for everybody? So I so appreciate all of you being here tonight, and just thank you very much.
And just to clarify, and thank you, Linda, also, the board members received a report from AFSCME dated July 10th, and obviously we haven't had time to read it yet, but we will, so thank you.
And I just want to add one quick thing, that the whole purpose of this is to have a study session, so we appreciate all the views that have been presented, including Linda's letter here. Thank you.
Let me just, I mean, I studied accounting and so forth, but I don't want to pronounce as a public accountant because I am not. But my understanding is the normal way that accounting is done, when we suddenly have to add a liability, and let's say we have rough numbers, $10 million in a reserve already for CalPERS, and we have to have put 40 million on our books. There is a $30 million net difference, which is a hit to our books. That will be recorded, I believe. I mean, it's sometimes, occasionally, they make direct entries to asset and liability accounts, but it's very rare. It almost always has to filter through the profit and loss, be recognized in the earnings statement, meaning we will have a $30 million loss on our books that year. I mention that because we've got some provisions about how we deal with losses and what that means, but we will have a $30 million loss. In terms of the reserve, the total reserve of the district, we take a big hit. We don't know, I mean, as CalPERS gets more conservative to the extent we do, and that could relate to how long people live, it could relate to what the investment earns, that unfunded liability could increase. If it in fact went up to $180 million, we'd have to record $170 million loss. We're effectively bankrupt at that point. I mean, that's literally true. I'm not exaggerating, that's the accounting reality.
Well,
I just believe that these are very serious matters, and it's really important that we understand very soon what our balance sheet's going to look like as a result of GASB 68. And I'm not sure who we even go to do that. The actuary clearly is not an accountant, I mean, by his own admission. So at some point, how are we going to do that?
Well, but a liability such as you described doesn't make us bankrupt. There's a problem here in trying to apply the private sector accounting standards to the public sector. What would make us bankrupt is if we were unable to pay our bills, and that's a different set of books than the one you're describing. We can, as a public agency, I'm not saying this is good, we can incur liabilities without having the liabilities per se affect our solvency. Our solvency depends on our ability to pay our bills based on our revenue. And the liability you described is in fact a liability on the books, but it's not a liability which we have to make a cash contribution to on an ongoing basis.
And Peter, I agree with you.
So the bankruptcy thing, I think, is a little bit.
Well, let me say, I was using bankrupt with the idea that our liabilities exceeded our assets, but you're right.
That's absolutely correct, but in the public sector, that doesn't mean anything.
Well, let me tell you where I think it does matter. But I'm agreeing with you.
I know it matters. But
it matters in terms of our own policy, where we've stated that we cannot lose money on a year-to-year basis without covering it by a reserve. That's our policy. At some point, the question is, how are we going to fulfill our policy? Are we going to cut expenditures to do so? So it does have a practical implication, or it could at some point. And it's enough that I think we at least ought to understand what it is.
I look forward to, learning more about GASB and how it impacts us. The policy which you allude to is one that we've established for ourselves. And the easiest way that you would deal with that dilemma is to change the policy rather than declare bankruptcy. And the nice thing about this is almost everybody I know, in terms of other local agencies, are going to be in worse shape than we are, because we have begun to reserve against it. And we are working cooperatively with our employees to try to figure out where we're going to go from here. There's no doubt that the books will look bad, but they will look great in comparison to most of our other public agency companions.
If I could, again, not being an accountant, but in looking at the situation, my concern is not really that unfunded liability, it's what's the payment to pay it off. I mean, if you had a $40 million unfunded liability and your contribution as percent of payroll is 15% of payroll, and it's not expected to change, and you clearly budget for that and you can afford it, it's not a doomsday scenario, right? The question for me is, from a cash flow standpoint, can you get from the 30 to the 40 or maybe higher and cover that cash flow? That takes care of that liability, eventually disappear. Accountants, that's a whole other issue about, how that looks on the books and accountants, all that. But anyway, I think it's important to think about what the contributions are and where they're going. And that's a hard cash outlay as opposed to an accounting entry. But I shouldn't, I don't want to diminish accounting or accountants as an actuary, but that's my 2 cents on how I look at it.
So Doug, can you just please remind me when GASB 68 is going to be effective? Is it 14, 15?
This year, right, 14 to
14,
15.
15, okay. So we'll have we'll have that information on our books, if that will be required to put down
Right.
our unfunded.
And CalPERS is working through how they're going to provide that and when, and I think they're going to have to charge a small fee to prepare it, and hopefully they'll have it by
They always
January.
charge a fee for something.
Well, in this case, the fact that it is a trust means that money has to be used for the participants, and this is a function for the agencies. And so I think legally the attorney is saying you can't spend time and charge projects for the agencies for their benefit. It has to be for the participants. And so they kind of draw a line there. And this is purely.
And the reality is that if they didn't do it, we'd have to hire somebody to do it.
Right.
And it's much less expensive to pay a small fraction of what CalPERS is going to pay than to pay 100% of what someone would charge us to do it. So,
Yeah.
I just wanted to know when that was effective, so thank you.
Yeah,
But
sorry.
let me follow up in Virginia. It's your understanding, though, that we would need to do that when we get our audit at the end of the year?
Yeah, your audited statement for this year, fiscal year ending June 30, 15.
At the audit time, it wouldn't have to go in as a, we do kind of unaudited reports monthly. We wouldn't need to deal with it at that point.
I don't.
we wouldn't need to deal with it, but I think, and particularly with your encouragement, Chuck, my hope is that during the year, we begin to integrate this in the way we look at things, because our asset and liability sheet is going to look very different as a consequence.
Yeah, that's why I
The
asked.
P&L isn't going to change, but the assets and liabilities are going to change dramatically. The P&L is going to be driven by what the contribution rate is, and we will have also their accumulated reserves in excess of what we have to pay, and that'll be an offset on the asset and liability side. We do not have a cash flow problem, but we do have a long-term planning problem, and for that I want to thank you in particular for encouraging us to have this study session, because I think it brings us all together in the same place. We are in a leaky boat, but we're all in the same leaky boat.
Ours is just leaking less than other agencies.
That's right.
Thank goodness.
thank you for those words, but I think, how should I say, we can only focus on what we're doing, and in some ways, I want to fix our problem. I don't want to just feel good that we're less bad than somebody else. That's not enough, so. What about any, yes, Chief?
So I know Doug didn't get to finish his one point, which was, so if the board, or actually if the option was available to the board to make a payment to CalPERS, because you said they're trying to figure that out, how soon do you think they would be prepared to actually be able to do that, know what it was, if you want to pay down against the prime rate?
I would think into this year, early next. I mean, you could ask them to get you, the 40 million, get you an update on that. For that matter, we could give you a better idea of what that number is today. I think they're going to need to have their more current valuation prepared, which are going out in October, November. And then once they have that, I think they ought to be ready to start giving you a better idea.
So basically first of next year.
Probably, yeah.
So that will be as soon as
Like
the,
6 months from now.
yeah, the board could actually evaluate whether that would be a good option or not a good option.
Along with that, are those numbers going to be current? Are they going to be like they have in the past where they're 2 years old?
Well, so yeah, they're gonna project them forward, so they will not be 2 years old.
Okay.
Okay.
But let's be clear, we're not talking about the rates, we're talking about the unfunded liability number.
Right.
Dollar amount.
That's
Yeah.
right.
Right.
Paying towards that.
Right.
So the current number is the 80 million based on June 30th, 2012, is that, I mean, 40 million,
40.
sorry, why
Right,
am
don't
I
make
thinking
it
80?
worse.
Sorry, it's the 40 million based as of the end of June of 2012.
Right.
I'd like to encourage the board, I'll say this by kind of moving to next steps, and I think we have about maybe 5 more minutes to do this, but I'd like to encourage the board to, even though we just finished the budgeting, I don't think it really matters at this point, I'd like to see us move toward placing on our balance sheet a reserve equivalent to the unfunded liability. I don't know how we get from there, and I don't want to suggest that we could do it in 1 year, maybe we can't, but I'd like to be able to go from the 10 million that we currently have reserved to the 40 million that we know roughly we're going to have. And where that money resides, we'll have to wait for a while. I mean, we don't have the option right now of putting it, earning 7.5% on it, but at least we could get the principal to that level. And somehow, I'd like to somehow do something with our budget so we are building up that reserve in some reasonable period of time.
So are you thinking, how soon, Chuck? Because in 6 months, we'll know whether or not we should pay down some of that. So do you want to do that now
Well,
or 6 months from now?
I
It's
think in
not
a
a
sense,
pay down issue, it's
yeah.
accumulating the reserve issue.
It's kind of
Oh, I
where
got it.
we're investing
Okay,
the money.
Yeah, okay, I got it. Sorry, that was my confusion.
But when I say a reasonable period of time, it seems to me we should try to get to that $40 million, say, in the next 2 to 4 years. I mean, that would be the.
See, I think that's a great agenda topic for, sometime in like September, October, say, okay, what is our target? Now that and by then we'll have a pretty good feel for what that figure is. And basically say, we want to move to a pay-as-you-go operation. And pay-as-you-go means that every year you basically cover all of your expenses, including your future liabilities. And right now we're behind.
Yeah.
And another way of looking at this, and please don't misinterpret this, because it's a way just of conceptualizing it. If you contract out everything, you pay as you go, because you pay people every year to do the services and you have no ongoing liability. And that's sort of the thing that I think we ought to be thinking about. How do we, every year, pay for all the services that we've received and recognize that part of what we've done each year is accumulate a future liability associated with the pension program, and that we can't simply continue to defer that pension liability. So Chuck is suggesting that we pick a target, 2 years, 4 years, 6 years. That's a political decision.
Right.
And then we start budgeting. Then every year what we would do is say, okay, here's our revenue. And this portion of our revenue is going to be going to closing that gap. And in 2020, when we have closed the gap, then every single year, we are going to put on the books enough money so that we don't have any increased liability. Now, there's going to be some, your job's going to be pretty tough at that point in trying to advise us as to what that figure ought to be. But we'll certainly be smarter than we have been in the last 20 years of just drinking the CalPERS Kool-Aid.
Maybe just go around the table and take 30 seconds to a minute for directors. Rob, do you have any comments you'd like to make?
Well, I think it's a good idea. And I think we need to be prepared for those types of large expenditures that are going to be in the next few years, because we do want to keep not only our fire district solvent, but we want to keep the good pension systems that we have, not only for current employees, future employees, and of course, on new ones now that are collecting pensions here with the fire district. So I think it's a good idea to explore, and I think the end of the year, going to some of these conferences through Cal Special Districts, they're supposed to come up with a figure, aren't they, at the end of the year for us, or a tentative figure if we ask for it? So I think we're going to get that probably in November anyway, if we ask for it. So, I mean, you're the expert. I think they're supposed to come up with something for us like
The figure.
that, if we request it.
Yeah, the unfunded liability.
Get done fund liability.
Well, yeah, that's the accounting information that they're gonna put together. Probably, I don't think it's happening in the next few months, but by early next year. They're gonna have to provide it to agencies, right?
Right.
So it's a matter of timing, and we're not hearing that they're gonna do it, be up and running with this in the next few months, probably early next year or something like that.
And then for those future percentages, that's why we have someone like yourself in order for us to budget for it, right?
Yes, it's also going to be a lot harder going forward, right? Because, in that $40 million figure of the unfunded, well, you have over $100 million in assets, right? So what happens in a year where, you have a year like 08, 09, you lose 20%, right? You've just lost over $20 million on your funded status. So to get whole, right, you're talking about $20 million going into the fund. It's going to, there's extreme volatility. Could do swap go the other way too. You end up overfunded, right? But there's going to be, there's only so much actuary can do, right? The market can do what the markets do. Yeah.
Virginia,
Yes?
any last comments before we break?
No, but thank you, Doug. Really appreciate the information and the dialogue.
And Rex?
Yeah, I think what is apparent to me is that it's part of an educational process, and I think part of that educational process is that our employees in the district need to have a collaborative effort to figure this out. I mean, we're all in this together. It affects them, and we want to make sure that we take care of them. And I think that the collaborative effort comes that we all sit down at the table just like we did tonight and discuss this stuff so that everybody's aware of it. How do we come up with a solution? If you got some ideas, I'm willing to listen.
I do have a comment, Chuck. Sorry. Oh.
I'm sorry.
Sorry.
Peter?
I just want to say that I do think that the measures that this board has taken and previous boards, especially Rex and Peter, have taken to make sure that the fire district is financially as healthy as it could be is really proving to be beneficial to us right now. And so I appreciate that. And I hope that we will continue on that track to be as prudent and fiscally responsible as possible. So thank you, Peter and Rex.
Yeah, the point I would make is that I think the real challenge to all of us, the board, the management team, the employees, is faced with these challenges, how do we continue to make this place an exciting, fun, rewarding place to work? And I think we need to collectively sort of say, okay, we can't do it all by the pension contribution issue. And we probably are going to need to be prepared to spend more in terms of current year expenditures, recognizing that we're going to have to be finding ways to reduce our future expenditures. I don't want us to get in the situation that I think San Jose's gotten itself into with the police department, where you cut salaries and you end up training people to go elsewhere, etc. I want people to continue to look at Menlo Park Fire Protection District as the place they want to work. Even though it may not have the world's best retirement program, it is the best place to work on a day-to-day basis. And so as we're looking at the way in which we spend our revenue, that's the kind of balance, with the help of my colleagues on the board, the management team, and labor, I hope we can achieve.
I'd like to just add one thing, and I think I agree, Peter, with what you said, and I'd hope we could do that too. I just had one, almost for me, a moral issue, and that is that it troubles me greatly to be working, to be using as a vendor CalPERS, where we joke about the morality, and I just feel that it's something that if there is any reasonable alternative, I hope we will explore it, because I just don't like working with an organization that probably, if it were in the private sector, the officials would have been jailed or at least charged, because making these promises that are unsustainable, and we see all these ads on TV with all the caveats. You can't make statements like CalPERS makes and do it with a straight face, and I just feel uncomfortable making use of them. So I hope that we have a solution. I don't want to go into more detail than that. I'm going to turn the microphone back over to Rex for public input and adjournment.
Okay. So that brings us to public comment number 2, which is, if you didn't get a chance on public comment number 1, now is your chance to go with public comment number 2. Anything that is not on the agenda? Nobody.
Move to adjourn?
Yeah, can I make one comment? I just want to thank Chuck Bernstein for really putting together this study session. I think it's been helpful. So thank you, Chuck.
Good. So it's been moved and seconded to adjourn. Our next regular meeting will be on July the 15th.
I moved. I don't know who seconded it.
I'll second it.
All those in favor?
Aye.
We are done.
Thank you, Chief. Thank you very much.
Thank you, sir.
Thank you.
Thanks, Michelle.
Thank you guys for coming.